Okay, so here we are in Chapter 10, at the end of our section on financial reporting. We've got one thing left to do, and that's the cash flow statement. And I have up here at the very beginning a quote from the FASB Statement of Accounting Concepts number 1, which is where they began to set the framework under which all accounting rules would be designed. And they say that financial reporting should help users assess the amounts, timing, and uncertainty of cash flows. Why? Because cash flows are wicked important. So here we're going to diverge from what we've done the last 8 chapters. We've been accruing and accruing and accruing, and now it's time to say, wait, if we don't have the cash to pay our bills, all the accrual revenues in the world aren't going to save us. So let's take a look at the cash flow statement and what we can do with it. Our cash flow statement is broken into these 3 parts, if you recall, which are the 3 functional areas of the business. And if you remember that little apple tree I drew, I decided to spare you my illustrative ability and swipe this picture from the internet. Starting from the bottom, we have the financing section, which is where we get the capital we need to grow our business. Here are our transactions with capital providers, where we're borrowing money and issuing shares of stock, paying that money back and paying out dividends. Also, that treasury stock we did goes in here as well. It's worth pointing out that interest, while a transaction with a capital provider, is an income statement item, so we'll put that up in the operating section. So we've got that money from our capital providers, and what do we do with it? We invest it. We build up our infrastructure with buildings and equipment and the like, and just like the trunks and branches of an apple tree, that infrastructure is what lets us do what we do. All the cash that we spend or receive buying and selling fixed assets and investment securities will go in the investing section of the cash flow statement. So what is our goal? If we're an apple tree, our goal is to photosynthesize and make apples. If we're Conan, our goal is to crush our enemies, to see them driven before us, and to hear the lamentations of their women. If we are a company, however, our goal is actually to run our business, buying and selling goods and services, generating profit for our owners. So the operating section looks at cash in and cash out from our day-to-day operations. This provides a good alternative to net income as a summary measure. 2 different ways of looking at the same transactions, one on an accrual basis and one on a cash basis. So why do we do all this work? Why are we taking the time to split the cash flow statement into these 3 sections? Surely we could do some simple arithmetic, comparing last year's cash to this year's cash, and we can see if it went up or down. Well, the answer continues to be, because it matters. Duh. It matters where that cash came from, more than simply saying we have more or less. What does it mean for us to have positive cash flow from operations? What must have happened? Well, the operating section has to do with our buying and selling goods and services, and positive cash flow means that we sold things for more than we paid for them, and that's clearly a good thing. Huzzah! So positive cash flow from operating is what we should be looking for. What about positive cash flows from investing? For us to have positive investing cash flows, what must have happened? Certainly it's possible we sold some of our stock portfolio, but for most firms that's a very small component of their overall business. It's more likely that the positive cash flow from investing activities means that we're selling our productive assets. And this, of course, is unsustainable. First of all, we're eventually going to run out of trucks and machinery and factories and the like. Second, if we just sold our factory, how much stuff do you think we're going to be making next year? Right, not a whole lot. Ideally, we're going to see negative cash flow from investing because that means management continues to make investments in the infrastructure that will keep our business growing strong. Positive cash flow from financing activities. What does that mean? It means we did one of 2 things. Either we borrowed money by issuing a bond or a note payable, or we went to the stock market and issued new shares of cash. We're tapping our capital markets. And of course, this is unsustainable too. If we keep getting money down here and spending it up here through poor operations, eventually the banks and the markets will stop giving us money. Ideally, we're going to be generating cash up here. Lots of cash. How much? Enough for us to fund purchases of new fixed assets, to replace those that are wearing out, and to expand our capacity. Negative cash flow down here. And enough to pay off our debts and maybe pay some dividends to our shareholders. A negative down here. That's the sign of a healthy, growing business. So that's why we do this. We're supposed to be providing information to decision makers, and separating these cash flows into their components definitely provides information. Now, what specific sorts of analysis can we do with this stuff laid out in front of us? Well, just like the FASB said, we should be able to assess the ability of the firm to generate cash in future periods. Where is that cash coming from? From operations or somewhere else? And what are we doing with that cash? Are we investing in new fixed assets so that we'll continue to be able to generate revenue? Or are we sitting back and paying it all out as dividends, letting our physical plant deteriorate? Can we pay dividends and meet our obligations? It bears repeating. We can't pay our bills with revenues. We need cash. So to whom do we pay how much cash? And what happens if conditions change such that, say, we lose 10% of our revenue base? Or what if the cost of our products' inputs spike? Are we going to be able to continue to make those payments both to our creditors and to our shareholders? Or are we going to have to let some things slip? Some of our payments are more discretionary than others. We can let a dividend go if we absolutely have to, or temporarily cut back on advertising expenditures. For some of our other expenditures, though, we can't do that. We can identify the differences between cash flows from operations and net income. Again, we can't pay our bills and profit. More importantly, though, we've seen over the last 7 chapters that accrual accounting is fraught with estimates, and peril, but mostly estimates. And we've seen how easy it is to fudge net income in one direction or another without even breaking a sweat. So cash flows from operations acts as a double check on net income. It's not impossible to manipulate cash flows, but it's much more difficult than accrual net income. So if something fishy is going on, we may be able to sniff it out here. The last thing to talk about is that the cash flow statement is actually supposed to disclose more than just cash flows. All the big ticket transactions in which we engage during the period should all be disclosed either at the bottom of the cash flow statement or in the footnotes. So if we issued stock in return for an acquisition of property and the amount is considered material, that should be disclosed here as well. So those are the types of things we can do with the cash flow statement. Now there are 2 ways of presenting the operating section of the cash flow statement, the direct method and the indirect method. Our choice of method has no effect on the investing or financing sections and has no effect on the outcome. It's simply a choice of presentations. Our first choice is the direct method. As the name suggests, we're going to calculate our operating cash flow directly. We will figure out who paid us how much and to whom we paid how much. We got paid by our customers. We paid our suppliers and our employees and the government for taxes and so on. And when we've totaled all that up, that's our operating cash flow. We look directly at the cash inflows and outflows from the period. Pretty straightforward. Our second method is the indirect method. And the indirect method acts as a reconciliation between net income and cash flows from operations. If we recall that operating cash flow is meant to be another way of looking at the same set of transactions we use to calculate net income, it shouldn't be difficult to figure out what the differences are. So, we start with net income on top, and then we figure out all the things that are different between net income and operating cash flow. And we've been doing that all along. What's the difference between sales on the income statement and cash received from our customers? It goes on the balance sheet as accounts receivable. So that's what we're attempting to do. We start with net income, and then we make our adjustments. We first adjust for our non-cash expenses and our non-operating items. What's our largest non-cash expense, and might be our largest expense other than cost of goods sold at all? Depreciation and amortization, right? We debit depreciation expense, and we credit accumulated depreciation. There's our expense on the income statement right here, but there's no cash associated with it. So there's a big reconciling item. This holds true for when we amortized bond discounts and premiums back in Chapter 7. That discount or premium amortization was a difference between income statement interest expense and cash paid for interest. And then we've got those non-operating items. When we sell a fixed asset, we get more or less than book value. We end up booking a gain or loss, right? Here's our credit to the asset, our debit to accumulated depreciation. We're going to debit cash, and then we plug to a gain or loss. And that gain or loss goes to our income statement. But we know that when we sell a fixed asset, the cash we receive from that sale belongs in the investing section. So we pull it out of the operating section right here. Same thing goes for when we retired that bond early. We ended up plugging to a gain or a loss, which went to the income statement, but paying back a loan is a financing activity. That doesn't belong up in operating. so we pull it out. Now, once we've done all this stuff, we do something that for now we'll consider to be completely mechanical. When I teach this live, I beg my students not to ask why, just to accept it as truth, and I'll explain how it works later. This being a recorded class, I don't really have to worry about that. But just so you know, I'll come back and explain how this works in a little bit. For now, don't worry about why. We're going to make adjustments for changes in our working capital accounts. Our working capital accounts are most of our current assets and liabilities, excluding investments and current maturities of long-term debt. Essentially, all the accounts that we use in the ordinary course of business. We're going to add to net income decreases in our current assets and increases in our current liabilities. And we're going to subtract from net income increases in current assets and decreases in current liabilities. At that point, we will sum up the column and we'll get to our cash flow from operations. This number will match what we could have come up with in the direct method. All we've done is change the way we present the calculation. Now, looking at these two methods, it seems clear to me that informationally, the direct method is far superior to the indirect method. The indirect method doesn't really tell you much that you couldn't have figured out on your own by looking at the balance sheet, income statement, and footnotes, which you're doing already. The FASB recognizes this and says that the direct method is the preferred disclosure in the financial statements. But if you choose to use the direct method, well, then you have to provide a reconciliation between net income and operating cash flows, which, of course, is the indirect method. So if you do the indirect method, you're okay. If you do the direct method, you have to also do the direct method. What do you think people do? Yeah, you're right. I've never seen a direct method cash flow statement in the wild. Why do the work twice? Go fig. So here's our example to work through and produce a cash flow statement. We've been given 2 years of balance sheet data, a single year's worth of income statement data, here, and a couple additional facts. And that's all we need. So before we get started with the indirect method, let's figure out what are the things we need to be aware of. There's, of course, the changes in the current assets and liabilities, but there's more to that. First of all, we have fixed assets, and that means what? We're probably going to have depreciation expense. How much? Well, let's see. Accumulated depreciation went up by $30 from $1,170 to $1,200. So we know that we've got at least $30 of depreciation expense. It's possible that we could have had more. If we had sold some fixed assets, we would have reduced accumulated depreciation as well, meaning that that $30 change would understate the true expense. We are told down here, however, that no property, plant, and equipment was sold during the year, so we're good. Looking at the income statement, we also see that we recognize the gain on the sale of investments of $80. That's an investing activity, but there it is sitting down there in net income. We'll need to adjust for that. Okay, we've identified our tricky things. Let's turn the page and do the statement. So, here we are. Where do we start? Well, where we always start with our indirect method, with net income. So there's our net income of $810, and then we adjust for depreciation expense of $30. Will we add or subtract this depreciation expense? Think about it for a moment, pausing the recording if you have to. Well, our net income was $810, and that includes $30 of depreciation expense. That expense was a negative, so net income has been decreased by a $30 charge, and that depreciation expense is non-cash. So if we want to go back to cash from accrual net income, we should add that depreciation expense back into net income. So we'll put that in as a plus. Next up is the gain of $80. We know that that's a non-operating item, since it has to do with the sale of investment securities. And what did that gain do to net income? It made net income go up. So we've got this big honkin' plus 80 in net income that doesn't belong in cash flows from operations. How do we fix that? By subtracting it back out. Minus 80 for the gain. So now we look to our working capital accounts, those day-to-day operation current assets and liabilities. We're going to skip over the cash account because, well, that difference is the point of this whole thing, so we shouldn't put it in here quite yet. And then we'll move to accounts receivable. Looking at the balance sheet, we see that accounts receivable went up, and our decision rule says that if a current asset goes up, we should subtract it from net income to get cash flows. Again, trust me for right now, it works. So there's negative $450 for the increase in accounts receivable. Inventory went down. Inventory is a current asset, and if a current asset goes down, we're supposed to add it. So let's put a plus 300 in for the inventory change. And that's it for our current assets. Looking at the liability side, we see that our accounts payable went up, and if a current liability goes up, we're going to add it. And then our accrued liabilities went down, which means we're going to subtract it. Very mechanical, very methodical, no thought required. And here we are at the bottom, and we will declare to the world that our cash flows from operating activities was a positive $860. So next we come to our investing activities. And what happened from an investing standpoint? A couple things, right? Looking at the balance sheet, we see that our fixed assets went up from $1,700 to $1,900. So we got $200 more in property. Does that mean that we have $200 of investing activity? No, not quite, because in the setup of the problem, I specified that we issued $70 of common stock in return for the equipment. So the entry that we would have booked would have been a debit to PP&E for $200, a credit to common stock for $70, and a credit to cash for only $130. So there's a negative $130 in our investing activities. Looking at the balance sheet, we see that our investments went from $1,420 to $1,300. So it's looking like we sold some. Selling an investment is an investing activity, so the cash from that transaction is going to go here. How much cash did we receive for selling those investments? Not $120. Why not? Because of that gain that we saw up here in the operating section. When we sold those investments, what did we do? We credited investments for $120. It looks like we credited gain for $80. How much did we actually receive in cash? It must have been $200 in cash. So that's what we're going to report as cash proceeds from investment sales. And this is why we took that 80 out above. If we hadn't, we would have double counted it. It would have been both in here and up in here. In total, we're left with $70 of positive cash flow from investing activities. Our last section is financing. And let's see what we did from a financing standpoint. Let's see, our bonds payable went down. How does that happen? By paying it off, of course. So it looks like we wrote a check for $150, and there's a financing cash outflow. Our stock went up by $200, so we issued new shares of stock this year. Not all $200 was cash though, right? Up here, when we bought that equipment, we paid for part of it with stock. So our cash flow from stock issuances is going to be $200 minus the $70, or $130 in cash. And lastly, we're told that we paid $230 in dividends. We didn't have to be told that. We could have figured it out by rolling our retained earnings T account forward, but we were told it, so let's put that into our financing section as well. And now we've got cash flows from financing activities, negative $280. We're not quite done yet, because we still need to do our roll forward from last year to this year. We've got our net cash flow of $650, which we add to our beginning cash of $1,150, and that yields ending cash of $1,800. Our cash flow statement rolls forward. Okay, now when I introduced the indirect method, I asked you to trust me on that current assets up and down thing, and promised to show you how it works later. When we see our current asset go up, we subtract it from net income, and that somehow magically works. So here we go. Let's just go right down the list. Where did we start? With accounts receivable, right? We began the period with $1,300 and we ended the period with $1,750. So let's fill those into our T account on the next page. Now what makes the accounts receivable account go up? Sales, of course. And what were our sales for the period? If we look on the income statement, we see what it was. Sales were $6,900. For the sake of mathematical simplicity, let's assume that all those sales were on credit. It's not required, but it's helpful. Stick a debit for $6,900 into accounts receivable. Now, our T account is crazy right now, so we're obviously missing something. What are we missing? cash collections. When the cash comes in, we debit cash and we credit accounts receivable, which means there's one and only one number that can make our T account roll, and that's 6450. So now look at that T account. We have revenue on the income statement of $6,900. We've got cash coming in the door of $6,450. What is that $450 difference? It's the difference between what we sold and what we collected, and it's the difference between net income and cash flows from operations. Why did accounts receivable go up? Because we recorded sales under our accrual accounting system, but did not record cash collections to go along with them. If we want to go from net income of $6,900 to cash flow of $6,450, what do? We subtract out that $450, and that's probably the most intuitive example of how this works. For what it's worth, the assumption that all sales are on credit is completely unnecessary for this to work. I would ordinarily ask someone in class to pick a number for how much of the sales were on credit, but that's obviously not going to work here, so I'll supply the number. Let's say that $5,000 of the sales were on credit and $1,900 were for cash. What does that do to our T account? Well, we still start with the $1,300 and we end with the $1,750, and we'll be increasing accounts receivable by $5,000 due to those sales. We get a new plug number for cash collections, and that's $4,550. However, we have to account for those $1,900 that were cash sales, debit cash, credit sales for $1,900. And when we add the two together, $1,900 plus $4,550, we're at $6,450, and we're right back where we started. So the assumption that all sales were on credit is a simplifier, but it's not required. Now let's look at inventory. Inventory has a beginning balance of $1,900 and an ending balance of $1,600, and once again we look to the income statement to find how this relates to net income. What on the income statement relates to inventory? Cost of goods sold. So we had cost of goods sold of $4,700 as a credit, and now we will fill in our plug box on the debit side. What number makes the T account roll? $4,400. Now we've been trying to explain the difference between net income and cash flows from operations, and the question is, what does this $4,400 represent? It is not a cash outflow. This is the amount of stuff that we bought, and we'll make the same simplifying assumption about buying for cash or buying on credit that we did on the receivable side. So they put the credit side of the purchase to accounts payable rather than cash, which means that we need to get our accounts payable account up here as well. Debit inventory, credit accounts payable. So we've started the year owing our suppliers $900. We bought $4,400, and yet we somehow managed to end the year only owing $1,200. How could that have happened? Either we had some very generous suppliers, unlikely, or we paid off some of what we owed, more likely. Debit accounts payable for $4,100 and credit cash. So what's the difference between accrual net income and cash flows from operations? Well, as it relates to inventory, we expensed $4,700 over here, but we only wrote checks for $4,100 over there, a difference of $600. Where do we find that $600 difference? Part of it is in the change in inventory, and the rest of it is in the change in accounts payable. This takes a little more work to wrap your mind around, but it's still the same idea, reconciling cash with net income. Our last one was accrued liabilities, which started the year at $250 and ended the year at $200. We look to the income statement and we see that we had $930 of SG&A expenses, and those are what's going to flow through this account. Well, most of them are. Not all $930. Why not? Because that $930 included the $30 of depreciation expense that we know is non-cash, debit depreciation expense, credit accumulated depreciation, not credit accrued liabilities. So we'll only take the $900 of expenses that need to be paid and put them into this T account here. So what does that mean that we paid? There's only one number that works in that T account, and that number is $950. That's the cash that went out the door. So once again, let's look at what we did on the cash flow statement. Accrued liabilities went down by $50, so we subtracted. And why does that make sense? Because we paid $950, but we expensed only $900. The expense on our income statement understates the cash that actually went out the door. So there we see how it is that those things work in the cash flow statement. The fact that one of these working capital accounts went up or down tells us that there was a difference between accrual income and cash flow. That's the whole point of those balance sheet accounts after all. Our receivables are the difference between our sales and our receipts. Our payables are the difference between our expenses and our expenditures, and so on. So what if we wanted to do this the direct way? Could we? Well, yeah. In fact, we just did. We just went through and said who paid us and how much. Our customers paid us $64.50. Whom did we pay? We paid our suppliers $4,100, and we paid for operating expenses. How much? $950. So we end with operating cash flows of $1,400, and the rest of the statement is the same, since the choice of indirect or direct method only affects the operating section. Now at this point, I would ask my students if they have any questions about what we just did. And of course, that doesn't really work in this format. But I'd keep asking, and keep asking, because there's something wrong. Take a few minutes and see if you can't figure out what's wrong, and then restart the recording. Okay, so did you find what was wrong? If you remember, I said that the direct and indirect methods are only different ways of presenting the same data. The end result shouldn't change. Cash is. There's really no fudging we can do about that. If that's the case, then why are operating cash flows $1,400 here and only $860 back when we did the indirect method? The answer is that we missed something just now. Going through and doing those T accounts works great so long as there are balance sheet accounts for all the things that have to do with cash receipts or cash payments. But go back and look at that income statement, and we'll see that we missed something. We had tax expense of $540 on the income statement. We need a new T account. What was the beginning balance in taxes payable? Ha! Trick question. The balance was 0. And what was the ending balance? Ha-ha! Another trick question, though probably much less successful than the first. That balance was 0 too. The income statement says tax expense was $540, so that would have been the debit, with the credit going to this taxes payable T account. Now, if we started the year with 0, incurred $540 of tax expense, ended the year with 0, what did we do? We wrote a check for $540 to pay off those taxes due. So we come back to our direct method and throw in that $540 there, and now they match. Okay, a couple parting thoughts about cash flows. The first one we've already seen. Investing activities will bleed up to the operating section when we sell an asset for a gain or loss. Say we sell some securities and recognize a $50 gain on the sale. All $125 of that sale belongs in the investing section as a positive cash flow item. And if we're using the indirect method, we'll need to back out that gain from net income. That's exactly what we just did in the example up above. This would also be the case if we sold a long-term asset like equipment or a building or something. The same thing goes for a bond retirement. Remember how we could retire a bond and recognize a gain or a loss there too? Same deal, but now the cash outflow would be a financing activity. Remember that major non-cash transactions need to be disclosed as well. So while we call it the cash flow statement, it's really supposed to be more than that. Remember that dividends are financing and interest is operating. They are both transactions with capital providers, but they belong in different parts of the cash flow statement. How's a good way to remember this? Interest is an expense, and dividends are not. The last thing is a warning about cash flows. This semester, we've spent quite a bit of time looking at ways in which net income can be manipulated to yield the results that we want the world to see. It isn't hard to do. If we can do it in BUA 400, it really ain't that hard. There are some who take that as an invitation to ignore the income statement and focus only on cash flows. Be very careful about this. Remember the reason we got into these accruals in the first place. Whether I get paid on December 31st or January 1st shouldn't matter for determining when I created wealth for the firm. Focusing on the cash in and cash out totally misses that and can yield some very funky financial results if we're not careful. But there's more to it than that. Remember back in Chapter 2 when I said the income statement was BS? And then I said the income statement is the best independent variable we've got to explain future firm performance in a regression. Net income is much more highly correlated with future earnings, future cash flows, and future cash flows from operations than cash flows are themselves. It's just a better summary. Lastly, it's possible to manipulate operating cash flow. It's not as easy, and it's more operational, but it can be done. So don't take cash flows as a bastion of purity. And with that, we are now done with the financial accounting section of this class. Alas. Beginning with Chapter 11, we'll start to look at internal uses for accounting information, including cost allocation, budgeting, and performance measurement.